Good morning, trading world. It is December 14th, 2022, and this is my pre-market outlook and technical analysis for day trading the markets. It's just after 8:09 a.m. on the East Coast, and the title for today's outlook is "The Feds Are Coming." The Feds are coming. A little humor in the title there. If you think the violent moves are done, think again. We are nowhere near done. Most of the time I look at the SPY, but I want to look at the ES because the small numbers in the SPY don't give the magnitude of these moves justice. Just like I have here on the chart, this is the ES right now. And just to take a look at the spike up yesterday and the equally violent move down, it's just amazing. So right now, do not take risks for granted. You need to understand P&L variance. You need to understand that if you are in positions now, you going into the Analyze tab on Thinkorswim and being able to play around with that P&L variance to see if your positions, if we take a 4% move up, 5% move up, or 4% move down, 5% move down, how that affects your profit and loss, and whether you could actually stand being in that position. So always, risk is very important to me. It's more important than direction. Because if you don't have capital, you can't play the game. And the name of the game is to protect your capital first. And have capital when it's time to put some on the line for bigger moves. So, got a little off kilter there, but just looking at the magnitude of that move always makes me think about risk and how important it is, and how most traders go into looking at things, what's my profit going to be, what's my target going to be first, whereas I usually think of things as how much or what's at risk first. Where is my cutoff if it goes against me? How much money am I putting up or at risk at the time to gain what? So for me, a lot of traders would fare a lot better if their thought process was that way first. But getting back to it, what is crazy, we have options expirations every day now on both the ES and the SPY, so you can really break it down. Oh yeah, and if the FOMC announcement wasn't making the market crazy enough, we have a triple witching on Friday's expiration to continue the craziness. And people may not understand how crazy or what that does, but as a trader, I cannot stand these triple witchings or rolls, because what ends up happening is that for someone like me, volume is an indicator that tells me a lot. So at any given time, whether it's intraday, whether it's short-term, long-term, volume tells me a lot. And especially intraday, I can look at volume and kind of see the seriousness or severity of certain moves. But when we have this triple witching, volume is thrown off. So it's like, volume is my hearing, and price action is my sight. And it's like trying to navigate through something with a loss of hearing. It just throws you off really bad. So that's what these option rolls and future rolls and triple witchings, that's what it does to a trader like me. But getting back to it, I still have the ES up. I went through the SPY yesterday, but I'm going to do the ES today. Going back, you can use T.O.S, the thinkback module in T.O.S. The expected move for the entire week this week was plus or minus 157 ES points. That's a jump from pretty much plus or minus 66 the previous week. That in itself tells you the minefield that we're in and the violence that is taking place this week. But going into this week, we've already finished 2 days this week. We still have expected moves of plus or minus 64 just for today, then plus or minus 81 for tomorrow, and then another plus or minus 86 on Friday. That should tell you how ridiculous the week is. The FOMC usually has some carryover for days after. Looking at the Fed probability tool, let me see if I can bring that up real quick. All right, you can see we got 4 hours, 41 minutes to the Fed announcement. And right now, we're sitting on, or we have a 79.4% probability of raising the rates 25 to 50 basis points, and only a 20.6% probability of raising the rates 50 to 75 basis points. This is not important, at least for me. What is important to me is, are we at a point where logic is normalizing? Meaning good news is now good news, or are we still in bizarro world where good news is bad news and vice versa? The reason this is important is because yesterday we got the CPI that was still very much high, but a little lighter than expected. My concerns are, does the Fed take the lighter than expected reading and use it as fuel to continue on the hawkishness with rates higher for longer? Good news is bad news. Or show some real dovishness by stating when they may begin to reverse policy on rate hikes, or at least level off, showing good news is actually good news. Now, for me, none of this is actually good news, because we must remember that each rate hike takes about 12 to 18 months before the real world feels the effects from it. So we're just feeling the effects of the first rate hike. And how many more do we have to go? Offhand, if I can remember correctly, we've had maybe 7 rate hikes and we're just feeling the first. So that tells you, or should give you, an idea of how I'm feeling about next year. Now, the other thing that I'm looking at, the professional money managers are caught in the cross. They're in full buy mode trying to make statements look good by buying pretty charts, things that are at or near 52-week highs. But a line is being drawn in the sand as far as how much higher this market will go before it breaks. The extreme to me is in two areas on the SPY, or at least on the SPY's top side. 408 to 410, which demonstrated beautifully yesterday. And then 416 up to 422. The reason why I say it demonstrated beautifully yesterday, I got in a short same day option expiration and netted close to a 500% return. Now, that was just an intraday move because I can clearly see that there's some fight up left in the market. And I don't want to be caught, in the midst of or giving profit back between now and the Fed or what have you the rest of the week and how it plays out. Now, even with that being said, there is still up moves ahead. But in my opinion, these up moves won't sustain. I'm just waiting for the kind of cloud or dust to settle from the FOMC announcement before I take any longer term positions outside of what I already have. So that's what I'm looking forward to today. Hopefully, based on where the indicators play out after the Fed announcement, will kind of give me an idea of how much longer or how longer dated positions I will be able to take. But yesterday definitely told me I was going to be in and out that day, not holding anything overnight. And today may be more of the same. I just have to wait and see how it plays out and where we meet as far as indicators and price action. Ooh, it feels like I had a lot to say and still have so much more to say this morning pre-market. But let me get to the key levels of the day because I could just kind of drag this on and on this morning. All right, here we are back with the key levels of the day. Starting on the resistance side, we have our jack resistance at 402 to the 403 area. Then we have our queen resistance 405 to the 407 area. And then we have our king resistance 408 to the 416 area. Now, even though I have this at, the 408 to the 416 area, I do want to make mention, as I brought up the extremes earlier, that there is an area up to about 422 in here that is not out of play. We could pop up a long ways and kind of level off, and in the days to come, kind of, somebody can yell timber and we start falling from that area. But that 422 is not out of play. So I want to make mention of that. But this area here, this 410 all the way up to this 415 area, this is an area that I have highlighted where there's a lot of overhead supply. And as you noticed yesterday, that's the area where we reversed. We've hit it once. There's a quote, persistence beats resistance. If we hit it a third time, there could be a possible break. And that 422 area you should have in the back of your mind as a place that we can wind up or go touch. Now, on the support side, we have our Jack support at 400 to 399, Queen support 398 to 396 area, and then King support 394 to the 381 area. Now, I know you're looking at this and saying, goodness, some of the resistance levels, like the King support level, takes up, a quarter of the chart. Well, the thing that we have to be careful of is that the market's being held together with band-aids and rubber bands right now. And if we break, especially on a day or week like this where there's a triple witching, professional money managers and all the buy the dippers are on one side of the market trying their best to hold it up. And if they fail, you have to understand there is nothing or no one below for some time to catch us. So we could enter into free fall, and that could take us a long way down. If we break today, it may not be a straight down candle to this 381 area, but over the next few days or week, it is a possibility. So I'm really having this in expectation of the triple witching that we have going on. So there's always going to be a lot of extra violence and moves the week of a triple witching, and especially the day of. So if you remember, my outlook for the week is bearish. Let me go back and kind of refresh your memory, but I'm sorry, let's see, the weekly outlook I have is bullish, but there's no harmony in it. So it's a retrace. So we could very well end the day up, but that's all the way back down towards 393. Being bullish for the week only says we have to close above the 393 level. So that's a long way down from here. The main thesis for today is bearish, closing below the 401.97 with a projected target low of between 399 and 381. The alternate thesis is bullish, closing above the 401.97 with a projected target high of between 401 and 416. Today is so volatile, don't be surprised that if you see both the bullish and bearish targets touched today. The current major channel we are in is 397 all the way down or all the way up to 416. The The major channel below is 397 down to 379. And I need to recognize the major channel above where we are, which is 416 all the way up to 425. Yes, moves could get that violent over the next few days. We have harmony between the technical, which is bearish, and the quant side, which is also bearish. We have a gap in order flow and strength below us. So no matter what happens today, I am looking for a revisit lower this week or next. I want to remind you, the main thesis for today is bearish. But with the Fed announcement and with everything that is going on, it is the alternate thesis that can be the most explosive. So be careful and be aware of the alternate thesis, which is bullish, meaning we could make our way up a long way. We could get up to that 416, and then it may take a day or so before we start to topple over. So you need to be aware of that. So from here, let's take a look at the scenarios of the day. All right, here we are with the first scenario. Whew, today is hard. Trying to put it together today. The probabilities are very, very close as far as what I'm looking for. And this happens sometimes, and it gets very hard to explain when all the things that I look at are kind of in that in-between area where it's not giving me the sign here, not quite giving me the sign there, but it's just in the middle. And when I place probabilities on the things, it's not that I'm trying to predict the market. It's because I'm a visual person, and this helps me to see things before it happens. It gives me an edge on what I'm looking for so that I can act as something is happening and not waiting until it has happened. So again, the probabilities are not a prediction. It just kind of gives me odds on what I need to be looking at first to see if this lines up or if that scenario isn't lining up in the things that I look at in that format, then go to the next scenario. So that's pretty much how I look at the scenarios. It's not meant to be prediction. It's just to kind of give me that extra step faster in identifying something as it plays out, instead of having to wait until you get too much verification and then the move is already done. So the first scenario is our expanded range day structure. We can have an initial slop. We'll call it a slop and chop, sideways to down, where the market is trying to get up and it's trying to ignite up, but it just never really seems to get going. And we do that into this, slop and chop sideways to, to almost down, and then start to go into a consolidation before FOMC or at lunchtime, our usual lunchtime chop. And then we come out at the FOMC announcement with a bang. We give another huge gasp down, then start a huge spike up. Usually the first move on an FOMC announcement is usually a head fake. So if we get a down move first, don't be alarmed. It's usually the head fake. We get down, then up, and then we kind of level off and everybody kind of joins the club. Oh, this is the way we're going. And, we take off and we could continue for the rest of the day. And that could see us at that 408 to 416 area. And remember, if we break through that area, 422 is not out of sight. We could pop all the way up there. And then this whole move could give away either starting today, overnight, tomorrow. And we could see the same thing that we saw yesterday as things just kind of fall apart and we start coming down. So my first moves that I may put up on the chart ahead of time at that maybe 416 area, it's probably going to be some type of put spread, bearish put spreads to kind of soften the blow of you never want to step in front of a freight train like this with directional or straight puts or calls, because if you're putting a lot, because I don't want to do anything near term expiration, I want to give myself a lot of time. And if you step in front of something like this trying to use a straight put, that is going to be very, very expensive, especially when you're trying to give yourself a lot of time. And you don't want to step in front of this with a straight put and it keeps going and it runs you over, and all the premium in that put gets deflated. So I would rather soften the blow by using a bearish put spread so that my risk is defined. It's not as expensive to add time to this so that I can put it further out, all the way through the end of the year if need be, and it still not cost me a whole lot. So that is the first scenario. I do want to say you need to be on alert for a vice versa scenario, a vice versa alert happening where this could definitely go the opposite way. So I'm going to say that on each scenario today. But let's move on to the next scenario. All right, here we have the second scenario, which is about the same probability as the first. It's our rounded reversal day type structure. We could get a continued push higher toward the Jack or Queen resistance area, find midday chop around either the Queen or King resistance. Going into the FOMC in that midday chop, and then come out at the FOMC meet with a wild spike before going back down with the same or more energy or force we went up with the first part of the day. So we're going to get this wild spike one way or another. It could be up, down, up, and then level off. It could be down, up, and it could go a number of ways. But just want to, put something up here for you to visualize and be prepared. And then we could kind of come off as the day goes on. So that is our rounded reversal day type structure. The other thing I want to stress is there could be a vice versa alert, and that vice versa alert could have us coming off pretty much the same way and then finding our midday chop going into the FOMC meeting, and then we could pretty much get a up, down, and then up, and that could continue on. Actually, let me do that a little better. It could continue on up, and we could have some continuation overnight and through tomorrow, and then kind of level off. Or who knows, this could continue up. The main thing that I'm looking for, I've said it earlier this week. Right now, the time frames are in a battle. The major time frames are in a battle where we have the daily, weekly, and monthly jockeying for position. And so when this happens, it is very, very hard to kind of plot where we're going. I used the analogy last week about a dog being on a chain. When you have this ferocious dog that's trying to get at you, and it's on a chain, and there's an extreme radius of where that chain lets that dog go, and that dog goes back and forth like it, bags up and takes a running start thinking it could break that chain. That's what's happening right here with price action. It's backing up and taking a running start trying to break out, and it's not being successful. So I'm waiting to see whether it gives up at some point and where it gives up. And my ideal is at one of these extremes, and that's the radius of the chain, so that I can take a position there and kind of wait for things to play out. But it's a complicated time of year because professional money managers are chasing performance, and they want to send out statements at the end of the year looking good, looking like their clients own the best stocks or the prettiest stocks. And retail traders, from that standpoint, professional money managers think that we're dumb. So they try to play the game of being able to explain it with pretty charts. Oh, I can just look and see how such and such stock has performed on the chart, how far it's up ahead of everything else, when fundamentally it's a bad stock, or the PE ratio is way overblown and it's waiting to implode. That's the position that professional money managers are in right now, trying to carry out that perspective and make those statements look good for the end of the year. So it's a lot going on right now, and this has to be the longest pre-market that I've ever done because I feel like I'm running my mouth way too much right now. But let's bring up the last scenario, which may not be that important, but we have to have an eye on everything that could possibly happen. All right, our last scenario is our trend day down. We could open gap down, start with a big rally back toward the previous close. We find resistance on or before that previous close represented by the blue line. Then we begin the downtrend of the day. We usually find midday chop around either the possible queen or king resistance. Today, we come out of that midday chop into the FOMC meet, which could bring us another violent spike down, which could be a head fake, and then back up. Excuse me. And we kind of level off and then try to start to continue up from there. But being a downtrend day, we kind of come up short of getting back to the previous close, which is represented by this blue line. So that is the scenarios for today. There is no more important day than this to be aware of your risk. Like I said earlier, understanding how to use the Analyze tab in Thinkorswim. Even though I cannot stay in Thinkorswim's performance right now, this is still, to me, the best platform as far as planning and scenarios, so that you can kind of play with it and set your slices to see what happens, where your portfolio ends up at with a 3% move up, 3% move down, a 5% move up, 5% move down, 10% move up, 10% move down, because that is extremely important to know whether you can handle that right now. As I always say, your most important job as a trader is to protect the capital that you already have. We do that by knowing and understanding the risk that we have on in each position and managing that risk in accordance to our account size. I hope this all helps, because I feel like I ran my mouth way too long today. But as always, wishing you a positive trading day. Let's make it a great one.